Don't put all your eggs in one basket. Have you ever heard that phrase? If you're anything like me and happen to watch Love Island this summer, don't judge, it was such a good season, then you definitely did, at least 100 times. But anyway, did you know that saying can also be applied to investing, in particular asset classes? If you're interested in learning more, grab something to drink, a little snack, and let's get into it. Asset classes are a group of financial products that act in a similar way and are affected by the same laws and regulations. Each asset class has different investment characteristics. These include the level of risk. This is all about how much an investor is willing to accept to get a certain level of reward. The return. This is how likely the investment will deliver a positive or negative return for the investor. Timelines. Is it a short or long-term investment? Typical performance in different market conditions. Could changes in interest rates have any effect on their value? Historically, the three main asset classes have been equities, bonds, cash. Today, the asset class mix also includes alternatives. Examples of these are real estate, commodities, collectibles, think of fine art, and crypto. You've definitely heard of Bitcoin, right? So in this episode, we will only cover equities, bonds, and cash. Equities, also known as shares, are units of ownership in company. They are issued by a public limited company, PLC, and are traded on recognized stock exchanges, such as the UK very own London Stock Exchange. Oh, by the way, a PLC is a company owned by shareholders and managed by directors. Basically, the members of the public are legally allowed to purchase shares in that business. Let's say Mario has decided to invest in equities. To do so, he buys one or more shares in Pizza is the Best PLC, as he believes this company will do well, because everyone loves pizza, of course. Mario is now a shareholder and part owner of Pizza is the Best PLC and can potentially make money from this investment. One way he can do this is by the value of his investment increasing over time. This can only happen because the company's value has increased. This is also known as capital growth. To put it simply, as the company grows in value, so does the investment. This means that Mario is now able to sell his shares for more than he paid for them. Another way is by Mario receiving income in the form of dividends, aka company earnings. This allows shareholders to share in, get it? The success and profitability of a company. It is important to emphasize that there is, of course, a risk that the share price will drop below what Mario initially paid for it, making Mario's shares worth less than what he paid for them, and that there is no guarantee that dividends will be paid. Ready to learn about bonds? Bonds also have a nickname, which is fixed income. So don't worry if you see or hear either of them. But what exactly is a bond? A bond is a loan taken out by a company, government, or another entity. Let's say I decide to purchase a bond worth £5,000. For this example, I'm using the 100% real European country, the Kingdom of Genovia. 10 points if you know what film I'm referencing. So yeah, I have agreed to lend Genovia £5,000 over 5 years. I am now their bondholder. In return, they will pay me back a set level of interest at 5%. Every year, which is £250. This is known as the coupon. And at the bond's maturity date, Genovia will also give me back my original £5,000. Wait a sec, have you noticed how many things are fixed in this agreement? The amount I'm lending, the interest level Genovia will pay me back at, the exact date I will get the value of the bond back. This is the maturity date. This is what makes bonds fixed income assets. It is important to flag that there is always a risk that Genovia might not be able to keep its promise to me. This could be for the coupon itself or for repaying the value of the bond on the maturity date. This is known as a default. Also, the value of the bond is usually quite sensitive to changes in interest rates. This means that the value of my investment can appreciate, yay, or depreciate. Boo. Now let's talk cash. Can you guess what a cash fund typically invests in? You guessed it, cash. Cash is how a lot of people get paid and what a lot of people use to make purchases, making it a very liquid asset. Cash funds also include cash equivalents, such as money market funds. These are very liquid, usually very safe, short-term debt securities. All cash funds aim to generate a competitive rate of interest, while being a secure option for investors. Scenario time. Anna is looking for a safe investment for a short-term basis, 90 days or less, that isn't too risky. Based on this, Anna has decided to invest in a money market fund that buys a 60-day debt from a company with a strong balance sheet and high credit ratings. This fund will pay Anna a small return as interest. That's it. Just like a flag with equities and bonds, the value of an investment and any income created from it can go down as well as up. There is always a risk that Anna may not get back the amount she invested. An important thing to also think about with cash or cash equivalents is inflation. If Anna decides to put money in a savings account, but the UK's inflation rate is higher than the interest rate the bank offers, her money will have less buying power down the line. Ready to recap? Equities tend to offer a high return, but this comes with a higher risk of losing your investment. Bonds tend to offer more stable return than equities, but have typically delivered lower return than equities over the long term. Cash tend to be the safest of the three, but also typically provide less return compared to the other asset classes. So, given each asset class has its pros and cons, you could argue that the smart thing to do is not put all your eggs in one basket. A full circle moment, I love that. Diversification is an investment strategy that helps minimizes risk and hopefully, if you're lucky, reap the rewards. I hope you enjoyed this episode of BlackRock Basics and make sure you join us for part 2, all about alts, coming soon.